In this video, we're going to put together the famous Fama French three-factor model. And first, we're going to try to motivate what caused Fama and French to come up with this and why it was in the early 90s and why it was so revolutionary that they did. See, Jean Fama, who just got the Nobel Prize in economics just a few years ago, Jean Fama was known as being a huge proponent of the capital asset pricing model. He had for years and years and years said, this is a good pricing model. You know, everybody should use it, and had been a big proponent of it, run a lot of tests on it and so forth. Well, in a very famous paper, I believe it was in 1992, he and his co-author, Ken French, came out with a paper that really rocked the foundations of economics and finance by saying, hey, we were wrong. Okay, the capital asset pricing model we don't believe in any longer, and we don't think beta does a good job of measuring risk and being used to come up with expected returns. And they said, here is why. And so I'm going to bring up a chart that are actually two tables from this paper that they did in 1992 that will help illustrate why they said that there are two other factors. There are two other things that seem to be influencing returns other than a stock's beta. So let me see if I can bring that up here. Yeah. Okay, so where it says panel A, this comes directly from the Fama French paper in 92. And let me see if I can do a good job of explaining what everything means on here. What we have is things are divided into deciles, groups of 10. So you've got 10% here, 10% here, 10% there, and so forth. So there's 10 deciles, which covers all of them. So what they did is every single month, starting in, I think it was June of 1926, up until the time the paper was written in 1992, every single month, they ranked all the stocks that were out there in order of the highest market cap to the lowest market cap. I should say, the lowest market cap to the highest market cap. So here is the smallest stock. Here's and here is the next smallest and the next smallest, and keep on going down. And here's the largest stock down here. At first, they used all the stocks that were traded on the New York Stock Exchange. Then when the NASDAQ came along, they added those. And then when we got better data measurements, they used all of them that are on what was called the CRISP index, Center for Research and Security Prices at University of Chicago. So where we see right up here, okay, where I'm pointing to where it says small ME, ME stands for market value of equity, which is size. That's the market capitalization. Okay, so this is going to be the smallest decile. Then this is the next smallest, and so forth. And where it says large ME, that's the largest decile. So that's the 1/10 that has the largest stocks in it there. Okay, so let's just first of all look where it says all here. And with this 1.25 just means that for all that time period, 1926 through 1992, I think it was, that actually would have been less than 1992 because the paper came out in 1992. So the research had to be done before then. But at any rate, over this long period of time, the average monthly return for all of these stocks was 1.25%. That's what the 1.25 means. That's 1.25%. That was the average monthly return for all of the stocks. Now, what we see here is the smallest decile had an average monthly return of 1.52%. The next smallest decile was average monthly return of 1.29%. The next smallest decile was 1.24. We go on down and we see that the largest stocks had 0.89 average monthly return. So it's clear that the smaller stocks did better on average than the larger stocks over this long period of time. The smallest stocks had 1.52% average monthly return. The largest ones had 0.89% average monthly return. And that was compelling to Fama and French. Now you might say, well, how did they find this? Well, they found it through something that some people call data mining. They looked at a lot of different things, and they were trying to say, what is it? This is this is definitely an empirical factor model. They're saying, what are the things that historically seem to impact returns on stocks? What is it about stocks that causes some stocks to have higher returns, some stocks to have lower returns? And they looked at tons and tons of things. And this was the first thing that they came up with, is that size makes a difference, that the small stocks seem to do better than the larger stocks. And they said, well, maybe it's just that these small stocks are high beta stocks, okay? And the large stocks are low beta stocks, and it's beta that's driving it. So what they then did is they went and they broke all these stocks every single month into deciles based upon their beta. So where it says low beta, that is the stocks, the 10% that had the lowest beta for each particular month. And then this B2 is going to be the next lowest beta, B3 the next lowest beta, and the one over at the end is going to be high beta. It's going to be the ones with the highest beta. And we find that for the stocks that have very low betas, you've still got the small stocks are doing better than the large stocks. For stocks that are kind of in the middle in terms of their beta, the small stocks are doing better than the large stocks. And for stocks with a high beta, the small stocks are doing better than the large stocks. So even when you account for a stock's beta, small stocks seem to be outperforming large stocks. So Fama and French said there is some sort of an inherent risk factor in small stocks that causes them to get a higher return, that causes investors to require a higher rate of return. It means they're priced a little bit lower, and on average, they do better. See, Fama and French believe very strongly in efficient markets. They believe that the only reason that causes some stocks to do better is because they're riskier. So they said small stocks must be riskier than large stocks. Stocks with a small market capitalization must be riskier than stocks with a high market capitalization. And it doesn't seem to be beta that is driving this. So what they did next is they said, we found something else in the same paper that also seems to be impacting stocks returns. And that is the book to market ratio. Now, the book value of a stock is simply going to be assets minus liabilities is the book value. The market value is the price of the stock. So if a stock has a high book to market ratio, that it's typically referred to as a value stock. A stock that has a, I'm sorry, I said that in reverse, please excuse me. Stocks that have a small, I'm sorry, I did say it right. Stocks that have a, I don't even remember how I said it now. Stocks that have a high book to market ratio tend to be referred to as value stocks. Stocks that have a low book to market ratio tend to be referred to as growth stocks. So this is taking a look, is a stock a value stock or a growth stock? And again, every single month, what they did is they ranked all the stocks that were out there. At first, it was just the New York Stock Exchange, and they added NASDAQ and so forth, like I mentioned before. And they said, let's take a look at the average monthly returns, okay, based upon the deciles. So where it says all right here, this high is going to be the book to markets. So this is going to be the stocks that are the most value stocks, okay? They have the highest book to market ratio. So because the price is in the denominator, okay? If you have a high price, that's going to be a low book to market ratio. If you have a low price, it's a high book to market ratio. So this is going to be stocks that would tend to have lower prices, stocks that would be considered to be value stocks, would be like a bargain. And on average, their monthly return for that long time period was 1.63%. And then these are the next, these are just a little bit lower. The next decile, 1.5%, the next decile, and so forth. And what we've got over here, these are the stocks that are the most value stocks, the ones that have a low book to market ratio. So it seems pretty clear that the value stocks are outperforming the growth stocks. So they said, well, let's see if that still holds when we separate these stocks based upon their size, because we just got done seeing that size has an impact on the returns. And what they found is these are the smallest stocks again, and these are the largest stocks. So amongst the smallest stocks, gee, the value stocks are outperforming the growth stocks. Amongst these stocks in the middle size, the value stocks are outperforming the growth stocks. And amongst the large stocks, the value stocks are outperforming the growth stocks. And it's not perfectly monotonic all the way across, but it's darn compelling, these two tables. So Fama and French said, hey, there seem to be two factors that are driving returns. And we believe they are risk factors. Now, we're not really sure, they said at first, what the risk is, but that smaller stocks are riskier than large stocks. Therefore, they get, on average, a higher return. It's compensation for the risk. And also that, that value stocks with a high book to market ratio, are riskier than growth stocks with a low book to market ratio. So on average, the value stocks do better than the growth stocks as compensation for the risk. So that's what they came up with in that famous 1992 paper. Then in 1993, they came out with another paper that was a formal model of this, and that was their famous three-factor model. So in order to show you the three-factor model, I'm going to need to bring up the whiteboard. And you may say, well, gee whiz, I know what two of the factors are. One of them is the size, and the other one is the book to market. What was the third factor? Well, the third factor, believe it or not, ended up being the market risk premium, R sub M minus R sub F, the same factor that is in the CAPM. Fama and French said that while that factor by itself, we don't believe in anymore, when you combine it with these other two factors, we seem to be able to account for expected returns in stocks. So what they ended up saying is this, that the expected return for a stock is equal to the risk-free rate, okay, plus beta 1 times risk premium 1 plus beta 2 times risk premium 2 plus beta 3 times risk premium 3. So the three factors each are going to have a risk premium. That first factor is simply R sub M minus R sub F. So that's the 5.7% risk premium, the market risk premium we've been talking about. So if we just stopped after that first factor, this would be the CAPM, it would be the same thing. But the second factor is going to be the size of the firm, okay? And the size of the stock, the market capitalization, the market value of equity. And the third factor is going to be value or growth, the book to market ratio. So what they needed to do is they needed to do a regression, okay, where they would find each stock's sensitivity to these three factors. And in order to do the sensitivity, it would look like this. They would say the return on stock I minus the risk-free rate. They would use the excess returns on the stock. That's going to be equal to alpha, okay, as all the regressions are starting out, plus the sensitivity to the first factor, that's beta 1, times the first factor. Now, what was the first factor? We said the first factor is R sub M minus R sub F. That's the first factor. Plus the second sensitivity to the second factor. And what was the second factor? They called it small minus big, SMB, for small minus big. We'll explain that in a little bit. Plus the sensitivity to the third factor, and the third factor they called high minus low. HML is high minus low. And then you've got the error term out there, which I've run out of room to be able to put. So this regression right here is going to give us the estimates of the three betas. It is a it's a multi-factor regression, multivariate regression, because there's three X variables. There's still the one Y variable, which is the excess return on the stock. And we have three three X variables. The first one is R sub m minus R sub f. The second is small minus big. The third is high minus low. Now, small R sub m minus R sub f, we've got data on that, okay? How much did the market outperform the risk-free rate by each of the last, months, all the way going back to the middle of 1926. So we've got all the data on that. Then what we need is we've got data. We need to come up with the small minus big. What is small minus big? It is a self-financing factor portfolio where what they do is every single month they ranked all the stocks from the smallest. So here is the smallest stock, and then they ranked them all the way down here every single month. And then here was the biggest stock right there. They took the midpoint, the median right there, and they said everything that's above the median is small, and we're going to go long on those stocks. Everything that's below the median is big, and we're going to short those stocks. So if we go long all these stocks and we short all these stocks, that means we're going long the small and we're shorting the big. That if the small stocks tend to outperform the big stocks, or let me put it this way, when the small stocks outperform the big stocks, this portfolio will be going up. When the big stocks outperform the small stocks, this portfolio will be going down in value. So your sensitivity, your beta 2, your sensitivity to that factor is going to tell you if this stock that we're looking at here acts like a small stock or if it acts like a big stock. We're not saying that this is going to tell us if it is a small stock or it is a big stock. For that, all we need to do, is just look at its market value of equity. That's not what we're trying to find out here, though. What we're trying to find out, does it act like a small stock or does it act like a big stock? A positive beta 2 means that it acts like a small stock. When the small stocks go up, it goes up. When the small stocks go down, it goes down. A negative beta 2 means it acts like a big stock, that when the small stocks go down, it tends to go up. When the small stocks go up, it tends to go down, and it tends to do what the big stocks do. For the third factor, high minus low, again, they arranged every single month all the stocks that they were looking at in order from the highest book to market ratio all the way down to the lowest book to market ratio. So the highest book to market ratio, those are going to be what we typically call the value stocks. The lowest book to market ratio, those would be what we typically call the growth stocks. This time, instead of taking the median, what they did is they went right here and they went right there. They said the top 30%, we're going to call them the high. The bottom 30%, we're going to call them the low. And this mid 40%, we're going to ignore them. So high minus low means we're going long on this 30% that's in the highest book to market ratio. These are going to be our value stocks. And then the low, we're going to be shorting them. And those are going to be the ones with the low book to market ratio. Those are going to be the ones that we would call the growth stocks. So high minus low means we're going long with the high book to market stocks, and we're going to be shorting the low book to market stocks. So what does this do? Well, Fama and Friends said, hey, we don't know exactly what it is, but these value stocks seem to be riskier, and on average, they get a higher return, which is compensation for risk. So if a stock acts like a value stock, beta 3 is going to be positive. That means it tends to go up when the value stocks go up and down when the value stocks go down. If beta 3 is negative, that means it acts like a growth stock. It goes up when the growth stocks go up and down when the growth stocks go down, and it goes opposite of the value stocks. Now, most stocks aren't going to move exactly perfectly with the value or the growth. So what we do is we're going to see, just like the beta for the CAPM, we're going to see any one of a number of different numbers. Now, it's important to understand that while the average beta for the CAPM was 1, the average beta for beta 2 and beta 3 is 0. That would be the average. Anything beta 2 that is above 0 acts like a small stock. The bigger that beta is, the more it acts like us. So in other words, like 0.001, it acts a little bit like a small stock, okay? But if it's like, 1.5 or 2, something like that, it means it acts a lot like a small stock. Okay. Beta 3, again, the average is going to be 0. Anything that's a positive means it acts like a value stock. Anything that is negative acts like a growth stock. The bigger that number is as a positive number, the more it acts like a value stock. The smaller the bigger negative, like a negative 1 or negative 2, something like that, means it acts even more like a growth stock. So we're going to get these 3 betas from running the regression, and then we plug them into our model up here, okay, our 3-factor model, beta 1, beta 2, beta 3. The risk-free rate is going to be our current risk-free rate. And then how do we get the risk premiums? Well, we're going to do what we said when we're talking about the self-financing factor portfolios with oil. We're going to take a look at how this small minus big portfolio has done over a very long period of time, and what it has, and use that as our risk premium for risk premium 2. We're going to take a look at this high minus low self-financing factor portfolio over a long period of time, and how that return has done, we're going to put in for risk premium 3. Risk premium 2 and risk premium 3 will both be positive numbers. Risk premium 1, of course, will be a positive number because the market has, on average, outperformed the risk-free rate. So this is the development of the famous Fama French 3-factor model. Any multi-factor model kind of goes along this way. Some researchers have come out with 4th and 5th and even 6th factors, which can be added on here. Okay, and you can read about them, but we're just going to focus on just 3 factors in here because that's plenty for us. I've got lots of data for us to look at for the 3-factor model. And in the next video, we're actually going to calculate the expected return for Apple in Excel using the Fama French 3-factor model.